Liquidity on chart, small hustle, big money. Liquidity is also classified into two categories, external and internal. External liquidity exists above major highs and below major lows. Internal liquidity, on the other hand, is found inside the range of price movements, usually near minor swing highs and lows. Market analysts at CNBC often highlight how external liquidity sweeps lead to bigger moves because they trigger a large volume of stop orders. Internal liquidity, though smaller in size, still plays an important role in intraday trades. A practical example can be seen in indices like the Nifty 50 or S&P 500. When price sweeps a previous high, it clears out seller stop losses, triggering sudden buying. But this move may not last, as the market can quickly reverse and target liquidity on the opposite side. This is why traders are advised to wait for confirmation instead of jumping into every breakout. Patience is a shield against false signals. Another important aspect of liquidity is imbalance. When supply exceeds demand, prices fall. When demand exceeds supply, prices rise. These simple economic principles drive every chart pattern we see. If more sellers exist at a level compared to buyers, the market becomes heavy and struggles to rise. The opposite is true when buying pressure dominates. Liquidity is essentially the visible footprint of this battle. The danger for new traders is treating liquidity zones as guaranteed trade setups. In reality, they're only areas of interest, not certainty. Big players often exploit retail psychology by creating fake breakouts at high liquidity levels, only to reverse the price sharply. Reports from Reuters frequently note how institutional strategies use liquidity traps to shake out weaker hands before continuing in the real direction. Retail traders must learn to recognize these traps and stay cautious. For practical trading, the best approach is observation and practice. Studying candlesticks around liquidity areas reveals where buyers and sellers are most active. Over time, traders can spot repeating patterns that show where the market is likely to react. No textbook can replace hands-on chart study. As professional traders often say, the chart tells the story if you know how to read it. To sum up, liquidity is the heart of trading. It is not just about numbers on a screen, but about understanding the behavior of buyers and sellers. Mastering liquidity zones gives traders the ability to anticipate moves instead of chasing them. Success in trading will always depend on discipline, patience, and continuous learning. But if there is one skill that sets apart profitable traders from the rest, it is their ability to read charts and understand where liquidity lies.